10 years since the powerful investment bank Lehman Brothers filed for bankruptcy. In the days that followed, global financial markets lost 60% of their value. Global economy contracted by 5%. An estimated 8.8 million jobs were lost, and $19 trillion of household wealth was wiped out. Why didn't anyone serve jail term for such losses? Is the world any safer now? And what did it feel to be at the helm of policy making in those dizzy days? In our series, Lehman Crisis 10 Years On, we speak to the men who mattered in 2008, here in India and abroad, to get answers to some of these questions. I have with me Professor of Economics at Harvard University, Professor Kenneth Rogoff. Professor Rogoff, thank you very much for joining me today in this very special series.
My pleasure. Thank you for having me.
Well, first up, can we say that the crisis has ended now and we are at normal times?
Well, yes, the crisis in the United States has ended. The United States is actually growing very well. The crisis in Europe is still fading. They haven't completely resolved the problems in the banking system, the European Union. And in some sense, we're moving on to what might be a third leg of the crisis. You might even call it a debt super cycle, if that's not too fancy, which is hitting emerging markets. And we wonder whether something will happen someday in China.
There are a lot of people who say that the crisis was not resolved properly, in that even where criminality was proved, the bankers just compounded and paid the money out of their banks. No one personally paid for excessive derivatives, excessive risk taken at and putting the entire system to risk. Would you agree with the charge that nobody, the banking community went scot-free?
I certainly would have liked to have seen at least one of the major banks beyond Lehman put into some kind of accelerated bankruptcy, nationalized and then quickly privatized as part of sending a very strong signal that this isn't allowed. And I think it might even have been good policy. So you're right. They protected the banking as entities, as corporations. And it certainly sits very uncomfortably with people that there were no more serious penalties on some of the bankers. I think that some of the populism we've had after the crisis would have been attenuated had they done that. But it wasn't that easy to do in the heat of things.
It isn't just the cry of nationalism in the United States or populist nationalism. We have seen that even in, for instance, in Brexit. Would you say that we may see more of populist nationalism, and much of it can be traced to the failure of the liberals during the financial crisis?
Well, I mean, it's a well-established empirical regularity that after you have a bad financial crisis, you get much more division in the political system. That's something that's happened in the past, and I think we're seeing it again. I think in the United States, the economy really is growing pretty well, and it's interesting to see how it will play out. Right now, the political divisions just get worse and worse. And you're right, Brexit could just be the beginning of what we see in Europe. So, of course, it's the financial crisis. I mean, it's other things like growing inequality, technology, the way global trade has been handled. I think it's many things, but the financial crisis made it a lot worse.
Okay. If we can extend this point a little further, how much time does it take to get over these divisiveness? Does it take a very long time?
That's a really good question. When you have a normal recession, a year, when you have a deep financial crisis like this, a systemic financial crisis, a decade. So in fact, what's happened in the United States, what's happening in Europe, it's kind of typical for, say, the 100 worst financial crises of the last century and a half. The average time to just get back to where you started is a good 8 or 9 years. And so, in some sense, this was typical. That is not a fixed point of nature. Some countries like Sweden, some of the Asian countries in the 90s did better. There are countries that have done worse. Greece has done much worse. They're nowhere near getting out of their crisis.
Okay. Let's come to that then. Are you not at all convinced that Europe has come out of the crisis? Just a little earlier, you told me that it's extremely tentative, the way in which Europe has healed from the crisis. Do you see them slipping back to some kind of a sovereign crisis?
Well, the thing that's holding up Europe at the moment more than anything is that global inflation-adjusted interest rates are very, very low, by some measures at historic or near historic lows. It's not easy to have a big debt crisis blow up in your face when interest rates are that low. Argentina is doing it. Turkey seems to be doing it. There's been fallout, I know, that's hit India and other emerging markets. But to actually have a full-blown debt crisis when lending rates are so low probably is not going to happen. And I think that's what's propping up Europe. But we don't really know why interest rates are so low. We have a lot of reasons, but we don't know which ones and how much. And if interest rates were to rise, I think Europe would suddenly find itself under a lot of pressure because there are countries like Italy, Portugal, we spoke about Greece, which are really not out of the woods, but they're able to tread water very nicely because they hardly have to pay anything on their debts. So Europe is not out of the woods. And in fact, I think if there was another major crisis of some sort in the world economy, Europe would have a very tough time with it. The Eurozone is a house half built where they integrated monetary policy, but little else.
Okay. Point taken. Let me come to the point you just made about if there is a rate hike. Do you think that the Fed's rate hiking cycle can be more than what the markets are prepared for? Do you see that as an imminent threat?
I absolutely do. I think the U.S. is really booming, and eventually it's going to start bringing so many people into the labor force and pushing up productivity, but it's also going to be pushing up wages, and the Fed might have to start hiking more aggressively. I don't see that in the near term, but I don't see this boom in the United States ending anytime soon. It's possible. It's certainly possible, but the best case is it goes on for at least another couple of years, and yes, the Fed would have to raise interest rates more. I think the markets have been too sold on the idea that growth is dead. This phrase, I don't know if you ever used it, secular stagnation.
Yes.
My colleague Larry Summers, they've been oversold on this idea. A lot of what we experienced was the financial crisis. It takes a decade to get out of a financial crisis. It doesn't, but they end. They eventually end. It doesn't mean it's going on forever. And I think we're in that phase where growth is picking up, investment's picking up. Not as much in Europe, but I do think that'll come, and provided there's no major shock, it'll put upward pressure on interest rates. How far it will go, I think, is a big question. But I do think, particularly at the long end of interest rates, not just you asked about the Fed, that's overnight lending. But I think if you look at 10-year rates, 30-year rates, they are well below where I think they're going to end up.
Actually, some of the experts I spoke to in the series and even outside believe that the U.S. economic growth is indeed, like you say, good to go for maybe a couple of years more at least. What are the odds of that happening? That growth is good, but inflation doesn't climb, and therefore the Fed doesn't have to hike so much?
Well, I think it's just a fact that economists have been surprised in Europe, in the United States, that there have not been more pressures on inflation. We have at least the official level of unemployment is very, very low. And so the idea that you'd be booming and workers would be drawn into the labor force, and it's all coming out in corporate profits, not so much in wages, is certainly surprising. Is that going to stick? I bet against it. I suspect if we keep booming, eventually you will see wages grow. But it's a very unusual circumstances. As you said at the outset, we haven't really had something like this since the Great Depression. So it's not easy to find long historical patterns on which to guess what's going to happen.
What's your own sense? You said that the 10-year yield and the 30-year yield at the moment are almost mispriced, are not reflecting the underlying momentum. 12 months on, say a year down the line, how much do you think the yields can rise, and how strong do you think the dollar index can get? It's standing at like 95 these days.
Well, the interest rate I particularly focus on is the 30-year inflation-adjusted interest rate, which is really low at the moment. So you buy an inflation index bond for 30 years in the U.S. I think it's a little under 1% now, plus you'd get paid for inflation, and the ordinary interest rate's 3%. I think over the next, I want to say more 2 years, at least both of those are going to be at least 1% higher, and that's very powerful in its effect on the economy. And the 10-year rate, I think, will also go up maybe 0.75% over the next couple of years. And those are the interest rates that actually matter the most for the exchange rate, for the global economy. Now, I do think other countries may do well also. So we could go through a period where, despite the fact the U.S. is doing well, other countries are also doing well, so it might not come out in the dollar. This won't go on forever. I want to be clear. Recessions will happen. But at the moment, I don't anticipate another deep financial crisis in the advanced economies.
Okay. Well, the 30-year rate at 4% and the 10-year rate at 3/4, probably a year down the line. What can that do to emerging markets?
I call it 2 years.
Okay, in 2 years. Well, what can that do to emerging markets is my next question. But I have to take a commercial break. We're coming back in a jiffy to discuss the current crisis in emerging markets and whether things look like they will get worse, especially if interest rates are headed higher. Back in a minute with Professor Kenneth Rogoff.